Do you own rental real estate or invest in syndications and expect that the losses coming from those K1s will reduce your taxes? Before you count on that deduction, you need to understand the passive activity rules. Hi, I'm Angie. I'm on a mission to help you keep more of what you earn, grow your net worth, and make taxes less stressful for you. In today's video, we're going to talk about passive activity losses, who can use them, who cannot, and what to watch out for. A passive activity loss is generally a loss from an activity where you're not materially participating. Common examples will include rental real estate, by default is considered passive, limited partnerships, and businesses where you're an investor. You've invested money, but you're not really involved in the operations. So here's the key rule. Passive losses generally can only offset passive income. That means if you have a rental property and you have a 50,000 loss, you may not automatically be able to use that loss against your W-2 wages, your business income, your interest or dividends. Instead, that loss may be suspended, not lost, but suspended and carried forward until you have passive income or you dispose of that activity. And this is where most folks get surprised. They buy rental real estate, get a cost segregation study because you heard about it, generate a large paper loss from depreciation, and assume that it's going to offset your high W-2 income. It doesn't happen by default. It happens sometimes only when an exception applies. So who can actually use passive losses? First of all, taxpayers with passive income may be able to use passive losses to offset that passive income. For example, if one activity generates a passive income and the other activity generates losses, then you can offset each other. Secondly, some real estate owners may qualify for a special $25,000 allowance, but this phases out as your income rises, so many high income taxpayers cannot benefit. Thirdly, what's called a real estate professional status may be able to allow you rental losses as non-passive, but only if you meet those specific rules for being a qualified qualified real estate professional. And fourthly, there's a loophole. Short-term rental owners may be able to avoid the default rental passive classifications if it's a qualifying short-term rental and there's criteria that makes it eligible for that short-term rental to be non-passive. But here's what you need to watch out for. Number one, do not assume that a K1 loss is deductible just because it appears on the K1. Number two, don't assume rental losses will offset W-2 income unless you have been planning for that. And number three, material participation must be really well documented. You need logs, calendar records, emails, proof of your involvement. And number four, real estate professional status is not just a label. It's not just a license that you go get. You generally need to meet the required time tests, and the facts must support the real estate as your trade or business activity. And number five, I'll mention group elections matter. How activities are grouped can often help you meet the material participation rules. And at-risk rules and basis limitations can also limit losses. So you have to be really, really careful. And last but not the least, state rules may not follow federal results. So you need to look at both federal and state impact. Bottom line is passive losses can be very powerful, but they're not automatic. You need to plan proactively for it. The tax code allows losses to reduce taxes in the right situation, but you need the right income type, the right participation level, the right structure, and most importantly, the right documentation. So before you invest in real estate or partnership, oil or gas, or any tax motivated investment, ask, will this loss be passive or non-passive? Do I have passive income to absorb it? Can I materially participate to make that non-passive? Do I meet any of the exceptions to make that non-passive? Will that loss be limited by my basis, by at-risk rules, or even state rules? And what documentation does IRS need? Because let me tell you this, The stakes are high, especially I've seen real estate professional status, folks taking that and not really qualifying, and IRS challenging it all the time. IRS is really what top on top of that. Because the goal is not to generate a loss. The goal is to generate a usable, defensible tax benefit that fits into your overall wealth plan. So be very careful with that and plan appropriately. If this was helpful, please like and subscribe to my channel, whichever platform you're listening on. This helps me bring advanced tax reduction strategies used by billionaires and big corporations to mainstream businesses and taxpayers like you and I.